Across the American landscape, small business owners and independent operators are encountering an economic environment marked by unprecedented operational strain, where decades of escalating regulatory mandates, compounding inflation, and structural overhead cost increases have systematically eroded profit margins across essential domestic industries. The independent trucking sector, long considered a primary bellwether for real economic output and consumer velocity, serves as a critical case study for this systemic contraction, illustrating how rising fixed costs directly suppress productive commercial activity. When an independent owner-operator with over a quarter-century of continuous commercial service is forced to shutter operations due to net annual operating losses exceeding $25,000, it signals a fundamental disruption in the mechanics of domestic freight logistics and supply chain viability. The microeconomic pressures driving small carriers out of business are particularly acute in highly regulated jurisdictions such as California, where compounding cost structures operate as an immense hurdle for small-scale enterprise. In these regional markets, commercial fleet insurance premiums escalating overnight from $11,000 to over $14,000 annually per power unit, alongside stringent state emissions mandates, high diesel fuel surcharges, and rising licensing fees, have created a climate entirely inhospitable to independent operators. Freight logistics cannot sustain continuous cost increases, while spot market transport rates decline due to weakening overall consumer demand, and when owner-operators are forced to absorb fixed overhead expenses that exceed gross revenue, the resulting capital depletion forces skilled labor out of the transport grid, reducing national shipping capacity and creating structural vulnerabilities across the entire domestic supply chain. The structural fragility of the real economy is further evidenced by the sharp contraction in official retail sales figures, where a reported drop of 0.6% in monthly retail activity represents a severe deviation from previous baseline growth trends and sharply misses consensus economic forecasts that had anticipated a 0.1% expansion. This sudden decline follows a period of marginal spending increases and indicates that consumer balance sheets have reached a critical point of exhaustion after enduring consecutive years of elevated living expenses. As households face compounding inflationary pressures across non-discretionary categories such as housing, utilities, food, and healthcare, the capacity to sustain discretionary retail spending has collapsed, signaling a broader macroeconomic slowdown that official baseline metrics have struggled to fully capture. This collapse in consumer velocity reflects a fundamental shift in household capital allocation, where American families are increasingly forced to prioritize survival-level purchases and allocate capital strictly toward non-discretionary line items such as grocery staples, electrical utilities, and mortgage or rent obligations, while completely abandoning secondary retail goods. Discretionary sectors, including home goods, secondary electronics, apparel, and durable consumer appliances, are experiencing significant inventory overhang as real wages fail to keep pace with cumulative price inflation. This contraction in real purchasing power demonstrates that the post-pandemic consumer buffer, once supported by accumulated emergency savings and expanded revolving credit lines, has been completely depleted, leaving the broader economy vulnerable to prolonged stagnation. The broader macroeconomic environment is defined by deteriorating consumer confidence, which has plunged to multi-year lows under the combined weight of persistent inflation and geopolitical uncertainty, creating a climate of widespread financial anxiety. This decline in consumer sentiment is compounded by escalating international military conflicts, particularly tensions surrounding Iran, which have disrupted global maritime transport corridors and applied direct upward pressure on energy markets. As crude oil prices breach $104 per barrel, the resulting transportation fuel surcharges act as an immediate tax on every layer of the physical economy, forcing households to revise their forward inflation expectations upward as they recognize that energy price spikes inevitably cascade into higher retail costs for food, manufactured goods, and basic services. This persistent inflationary environment leaves monetary authorities trapped within a severe policy dilemma, facing contradictory economic mandates that traditional monetary tools cannot easily reconcile. The Federal Reserve must defend against persistent supply-side inflation by maintaining elevated short-term interest rates, yet sustaining real economic output and managing sovereign debt obligations demands liquidity injections and rate reductions. Attempts to suppress inflation through restrictive monetary policy elevate capital borrowing costs, placing immense strain on debt-dependent sectors like commercial real estate and regional banking, whereas easing policy to relieve interest rate pressure risks, triggering rapid currency devaluation and secondary inflationary waves, demonstrating that central bank mechanisms are increasingly constrained when addressing supply-side disruptions and fiscal deficits. As confidence in traditional fiat instruments and central bank policy erodes, global capital is increasingly reallocating into physical tangible assets to hedge against monetary debasement and systemic counterparty risk. Gold and silver continue to demonstrate their historical role as premier capital preservation vehicles, recording significant single-session spot price advances, with gold advancing by $30 per ounce and silver expanding by $45. Even as broad equity markets experience heightened volatility and uncertainty. Meanwhile, the benchmark 10-year United States Treasury yield remains elevated near 4.7%, reflecting persistent institutional demands for higher risk premiums on sovereign debt instruments as national debt levels approach unprecedented thresholds. The performance divergence between physical precious metals and digital speculative assets highlights the distinct mechanics governing capital preservation during periods of market stress and macroeconomic realignment. Over an extended annual observation window, physical gold recorded gains of roughly 34%, whereas Bitcoin experienced drawdowns exceeding 47% from its local peaks, revealing a sharp contrast in how these markets absorb economic shock. While digital assets were originally engineered to function as decentralized hedges against monetary expansion, their financial integration via spot exchange-traded funds and institutional brokerage desks has tied their trading behavior closely to high beta risk assets and broader liquidity cycles, rendering them susceptible to aggressive institutional liquidations. Unlike digital tokens, physical precious metals operate entirely outside the digital financial architecture, holding zero counterparty risk and requiring no network infrastructure, power grids, or clearinghouses to validate ownership. Physical bullion remains exempt from direct centralized network intervention, regulatory freezing, or technological disruption, making it an essential holding for those prioritizing absolute asset control. For institutional and retail allocators seeking shelter from systemic sovereign debt risks, particularly as national debt levels climb toward $40 trillion, physical precious metals remain the primary non-liability reserve asset, and purchasing physical bullion during key market pullbacks represents a strategic positioning strategy designed to insulate accumulated wealth from currency debasement and long-term monetary dilution. The structural cost pressures squeezing domestic transportation and energy markets are simultaneously exerting severe stress on the national food production and distribution apparatus, directly impacting household budgets across the country. Consumers encounter persistent price increases across retail grocery outlets as cumulative input costs, ranging from diesel fuel surcharges and fertilizer inputs to agricultural labor and processing overhead, cascade down to the end consumer. These compounding cost structures have triggered the largest sustained price increases in agricultural staples in over half a century, fundamentally altering consumer shopping habits and forcing households to adjust their dietary purchases to match declining real wages. At the structural core of this grocery inflation is a severe national cattle shortage, which has severely disrupted domestic protein processing networks and elevated raw material costs for meat packers. Major industrial processors, including Tyson Foods, have initiated structural downsizing programs to cope with declining livestock herds and elevated operational overhead, leading to widespread industrial restructuring. The announced closures of major facilities, such as primary processing operations in Joslyn, Illinois, and Eagle Mountain, Utah, will eliminate over 3,500 industrial jobs while reducing national beef processing capacity, illustrating how structural supply deficits, rising agricultural overhead, and shrinking livestock inventories compound one another to ensure retail food prices remain elevated regardless of top-line consumer demand. The real-world consequences of sustained inflationary pressures are increasingly visible in the deteriorating financial health of the average American household, where day-to-day liquidity management has become a constant challenge. Recent consumer liquidity studies indicate that approximately 44% of individuals living paycheck to paycheck have incurred punitive bank fees, including overdraft penalties and late payment charges, simply trying to manage basic cash flow between pay periods. Overall, roughly 63% of the domestic population operates without meaningful cash reserves, leaving tens of millions of households vulnerable to minor financial disruptions such as vehicle repairs, medical copays, or utility adjustments. This widespread reliance on short-term revolving credit and liquidity buffers has transformed basic banking interactions into an additional financial penalty for low- and middle-income households, compounding their existing financial burdens. When families lack sufficient liquid buffers to cover basic monthly obligations, the resulting bank fees directly reduce their net disposable income, accelerating a downward spiral of personal debt. Capital is therefore increasingly viewed not as a vehicle for speculative wealth accumulation, but as a critical operational tool required to preserve personal autonomy, secure stable housing, maintain reliable private transportation, and protect family security amidst a deteriorating economic backdrop. The structural economic decay observed across transport, retail, and agricultural sectors is reflected in national child poverty metrics, exposing deep socioeconomic fractures within the domestic population. According to international socioeconomic surveys compiled by comparative economic research institutions, child poverty in the United States has reached approximately 21.1%, meaning 1 out of every 5 American children between the ages of 0 and 17 lives below official poverty thresholds. This metric positions the nation behind several developed countries, highlighting a deep disparity between top-line national wealth figures and the day-to-day economic reality experienced by millions of domestic households. The coexistence of high child poverty rates with record-setting national debt highlights systemic misallocations of capital within the national economy, where fiscal priorities often fail to address pressing domestic needs. With national debt exceeding $39.9 trillion, interest servicing costs on sovereign obligations now consume a rapidly expanding portion of the federal budget, constraining future policy options. As hundreds of billions of dollars are directed toward foreign aid packages, foreign defense initiatives, and regional geopolitical conflicts. Domestic social infrastructure and economic stability continue to erode, leaving local municipalities and working families to absorb the costs of persistent inflation and shrinking public resources. The fragility of global trade paths is highlighted by escalating maritime threats in critical international shipping corridors, particularly throughout the Middle East, where geopolitical instability directly impacts economic liquidity. Recent maritime incidents, including drone strikes targeting commercial oil tankers near the Strait of Hormuz and major industrial oil spills off the coast of Oman, have transformed the Persian Gulf into a high-risk transit zone for international commerce. Because approximately 20% of global petroleum shipments pass through the Strait of Hormuz, even minor security disruptions directly trigger sharp increases in global energy risk premiums, elevating shipping insurance rates and fuel costs worldwide. These persistent maritime security risks represent a calculated strategy designed to exert continuous economic pressure on Western markets through supply chain friction and energy market volatility. By threatening tanker traffic through strategic maritime choke points, asymmetric forces can maintain elevated global crude oil prices, forcing Western central banks to contend with persistent supply-side inflation that monetary policy alone cannot fix. This persistent disruption complicates international diplomatic efforts and ensures that transportation fuel surcharges remain elevated, directly increasing the landed cost of imported raw materials, industrial inputs, and consumer goods globally. In an era defined by compounding economic, geopolitical, and financial volatility, personal resilience requires a proactive, structured approach to risk management rather than reliance on centralized institutional interventions. Relying on government policy pivots or financial institution bailouts to restore economic stability overlooks the structural nature of current global challenges, making individual foresight essential. Households and business owners must build systemic resilience across financial, physical, and mental domains by minimizing high-interest revolving debt, securing physical reserves of non-perishable goods and essential supplies, maintaining localized community support networks, and acquiring non-counterparty tangible assets like physical gold and silver to safely navigate the ongoing economic transition.